The S&P 500 has outperformed the S&P 500 equal weight index by over 5 percentage points so far this year. This may sound like a small technicality, but historically, this kind of outperformance has led to significant gains in the following year. So if you're holding key AI and tech stocks, you'll want to pay close attention. Let's break down why this matters. The S&P 500, which tracks the largest 500 companies in the US, is weighted by market cap. This year, these so-called Magnificent Seven tech giants, which also include Google, Amazon, Meta, and Tesla, have driven much of the index's growth. In fact, just Apple and Nvidia alone accounted for about a quarter of the S&P's gains since 2019. We've seen this happen in years like 1991, 1996, and most recently in 2020. This pattern suggests that the tech-heavy, concentrated nature of the S&P 500 might actually work in its favor in 2025. But here's the kicker. The S&P 500 currently trades at a price-to-earnings ratio of 26.7, which is significantly above its 10-year average of 21.8. And within the Magnificent Seven, the average PE ratio is an even higher 42.5. This elevated valuation means investors are paying a premium. So what does this mean for AI and tech stock investors specifically? For one, high valuations could be a double-edged sword. On the positive side, companies like Nvidia, which saw a 206% rise in earnings last year due to AI-driven demand, are leading the charge in innovation. If these companies continue to deliver strong earnings, the S&P could indeed see another impressive year in 2025. Analysts expect the Magnificent Seven to continue outpacing the rest of the market, with earnings growth projected at 18% in 2025, compared to just 14% for the rest of the S&P. But the high concentration in these tech stocks also poses a risk. If any of these companies miss earnings targets, it could have a ripple effect on the whole index. In fact, Goldman Sachs estimates that, due to this concentration and high valuations, the S&P 500 may only return 3% annually over the next decade, compared to its historical average of 11%. Adding to the complexity is the Federal Reserve's recent decision to cut interest rates with expectations for more reductions in 2025. Since 1980, 5 of the 10 best-performing years for the S&P 500 have occurred during rate-cutting cycles, so lower rates could act as a tailwind for tech stocks, particularly those in high-growth sectors like AI, which are heavily reliant on capital. Cheaper borrowing could fuel even more investments in AI R&D, boosting companies like Microsoft and Alphabet. So, should you buy individual AI tech stocks or stick with the S&P 500? Here's my take. If you're comfortable with higher risk and aiming for potentially higher rewards, investing in individual AI and tech stocks could be a solid option. These stocks, especially in the Magnificent Seven, are at the forefront of innovation. With companies like Nvidia seeing a 206% rise in earnings from AI demand, individual tech stocks could continue to outperform. However, remember that these high valuations mean any missteps in earnings could lead to volatility. On the other hand, if you're looking for stability with exposure to tech, the S&P 500 offers a diversified approach. Historically, after years like this, the S&P 500 has averaged a 17% gain the following year, and with potential rate cuts, the index could benefit from a tailwind. In short, if you're chasing growth and can handle volatility, individual AI stocks may be for you. But if balanced exposure to tech and broader sectors sounds right, the S&P 500 could be a wise choice.